Right now, as you watch this, something unprecedented is unfolding inside the Canadian economy. And the most alarming part, the Bank of Canada just told you exactly what is happening. They put it in writing, they gave it a name, and almost no one is talking about what that name actually means for your retirement portfolio, your wealth, and your long term financial security. On February 5th, 2026, the Bank of Canada delivered a speech called Canada at a Crossroads. That title alone should have stopped every investor, every pension holder, every homeowner in this country cold, because what they buried inside that speech wasn't a forecast. It wasn't a warning, it was a confession. They called it a structural break. Let that sink in for a moment. Your central bank, the institution responsible for protecting the purchasing power of your savings, your 401k equivalent RRSP, your pension, just admitted that Canada has entered a permanent structural shift, not a recession, not a rough quarter, a structural break, a point of no return. And this part has already begun. This is not theoretical. This is observable. The data is already in the numbers. The mechanisms are already in motion. And the consequences for your retirement savings, your real estate equity, and your portfolio risk are more serious than anything they're saying in the headlines. Let me show you what actually happened. For years, decades in fact, the Bank of Canada operated on a fundamental assumption that when the economy slowed, they could cut interest rates, stimulate borrowing, and growth would return. The machine would restart. That assumption is now dead. Here's the part they never put in the official reports. Monetary policy, interest rate cuts, works against cyclical downturns. A cyclical downturn is temporary. It's a demand problem. You reduce rates, borrowing increases, spending picks up, and the economy recovers. That's the textbook. That's what central banks were built to do. But a structural break is something entirely different. A structural break means the foundation itself has cracked. It means the underlying drivers of economic growth, productivity, labor supply, trade architecture, capital investment have permanently shifted, and interest rate cuts cannot fix a foundation. You cannot cut rates hard enough to rebuild a broken structure. This is the mechanism hiding in plain sight. The Bank of Canada is now explicitly on record saying that the era of open trade with the United States, the single most important pillar of Canadian economic growth for over 30 years, is over. Not weakened, not disrupted, over. The integrated supply chains, the cross-border investment flows, the export architecture that Canada built its entire growth model around, that model is fractured. And here's where everything changes. Canada's productivity problem didn't begin last month. Output per worker in Canada has lagged the United States for over a decade. Business investment per worker is lower in Canada than in virtually any peer economy. That gap has been widening for years. And now the trade shock, the US tariff escalation, the supply chain realignment, the fracturing of the cross-border economic relationship has landed directly on top of a productivity base that was already crumbling. This is where the first domino falls. For the average household, this means something very specific. When productivity stagnates, real wages stagnate. When real wages stagnate, the purchasing power of your savings erodes, not from a single dramatic event, but slowly, relentlessly, year after year. The number in your retirement account appears to grow, but the real value, what it actually buys, quietly shrinks. That is the invisible mechanism that is already at work inside your portfolio right now. But that's not the real problem. Here's what I call the big secret of the entire system. Monetary policy has one tool, interest rates, and that tool has one function, managing demand. But Canada's problem is not a demand problem. It is a supply problem, a structural supply problem. A problem of declining potential GDP growth. A problem of aging demographics, collapsing labor force expansion, and productivity stagnation. Interest rates cannot fix any of those things, which means the Bank of Canada just admitted in plain language that it cannot fix what is broken. This is not a prediction, this is arithmetic. The Bank of Canada's own language in the February 2026 speech is extraordinary if you read it carefully. They stated that the labor force will hardly grow at all for years. Think about what that means for a moment. Labor force growth is one of the two primary drivers of GDP growth. The other is productivity. Canada has weak productivity growth. And now the BOC is projecting near zero labor force growth. Two engines of economic expansion, both stalling simultaneously. That number should not exist, but it does. And this is where the cascade becomes unstoppable. Canada's population has grown rapidly in recent years, driven by immigration, and headline GDP numbers, total economic output, have risen alongside that population growth. Politicians pointed to those numbers as evidence of economic health. But here is the detail even analysts tend to miss. GDP per capita, the real measure of individual prosperity, has been falling. You can grow a country's total output by simply adding more people. But if each person is producing less, earning less, and accumulating less wealth, the headline number is a fiction. For the average retirement saver, this is catastrophic in a very specific way. Your RRSP, your pension, your long-term wealth preservation strategy, all of these were built on an implicit assumption that Canada's economy would continue to grow, that asset prices would rise, that inflation-adjusted returns would remain positive. The structural break the BOC just announced challenges every single one of those assumptions simultaneously, because what comes next is worse. Here is the part nobody expects. Canada's housing market has long been treated as the shock absorber of the economy. When other sectors slow, residential investment picks up the slack. Construction employment, household spending, consumer confidence, all of it has been propped up at least partially by an overheated real estate market and a housing sector that represents a far higher share of Canadian GDP than virtually any peer economy. But here is the counterintuitive reality. High household debt, which Canada carries in extraordinary concentration, does not make a structural slowdown easier to navigate. It makes it almost impossible. When growth slows structurally, income expectations fall. When income expectations fall, highly indebted households face a compression of future spending capacity that no rate cut can fully reverse. The mortgage risk embedded in Canada's residential sector is not a housing story. It is a systemic risk story, and it sits directly inside your net worth calculation. This is not cyclical, it is structural. The Bank of Canada knows this. That's why the speech was titled Canada at a Crossroads, not Canada navigating a downturn. A crossroads is permanent. You make a choice at a crossroads and you live with it. The BOC is telling you in the most careful institutional language possible that the choice has already been made for you. The structural break has occurred. The old Canada, the Canada of export-led growth, integrated U.S. supply chains, rising real wages, and expanding labor force is gone. This is vanishing in real time. And we are only at the beginning of understanding what that means. Let me be precise about what a structural break actually does to your wealth over time. It doesn't announce itself. It doesn't arrive with a market crash headline or a single catastrophic event. It moves quietly through your portfolio, through your pension, through your real estate equity, through every asset you've spent a lifetime building. It works through the slow compression of real returns, through the widening gap between what your savings earn and what your life actually costs. And this part has already begun. The Bank of Canada confirmed something in that February 2026 speech that institutional economists have been watching build for over a decade. Canada's productivity growth has been lagging the United States so consistently, so persistently, that it is no longer accurate to call it a gap. It is a structural divergence, and structural divergences do not self-correct, they compound. Here's the mechanism hiding in plain sight. Output per worker in Canada trails the US significantly. Business investment per worker, the capital that goes into machinery, technology, research, and the tools that make workers more productive, is lower in Canada than in almost any comparable advanced economy. And here is the part the experts gloss over. Capital investment and productivity are not separate issues. They are the same issue. When businesses do not invest in upgrading their capacity, workers become less productive. When workers are less productive, wages stagnate in real terms. When real wages stagnate, the purchasing power of every dollar sitting inside your retirement savings quietly deteriorates. This is not theoretical. It is observable. It is already in the data. For the average Canadian household with a pension or an RRSP, this is the real inflation story, not the headline consumer price index, but the slow erosion of real purchasing power against an economy that is producing less per person every year. Your portfolio might show positive nominal returns, but in real terms, adjusted for inflation, adjusted for declining productivity, adjusted for the shrinking capacity of this economy to generate genuine wealth, the picture is far more troubling. And here is where the cascade becomes unstoppable. Now layer the trade shock on top of that productivity foundation. Canada exports approximately 75% of its goods to the United States, 75%. That is not a trade relationship. That is a structural dependency so deep that it effectively means the Canadian economy runs on American demand. And the Bank of Canada just told you that this era, this model is over. Here's the part they never put in the official reports. The US-Canada trade integration was not built overnight. It was assembled over 30 years of deliberate policy architecture. Free trade agreements, cross-border supply chains, harmonized regulatory frameworks, deep capital flows. Dismantling that architecture or even partially fracturing it through tariffs and trade uncertainty does not produce a short-term disruption that corrects itself. It produces a permanent realignment of economic structure. Industries that built their production models around frictionless U.S. market access must now rebuild. Supply chains that ran seamlessly across the border must now be rerouted, restructured, or in some cases abandoned entirely. This is where the first domino falls. The industries most exposed, automotive, energy, agriculture, manufacturing, are not peripheral to the Canadian economy. They are the Canadian economy in many of its most productive regions. And these are precisely the sectors that employ the workers, fund the pensions, support the mortgage payments, and generate the tax revenues that underpin the social infrastructure that Canadians depend on for retirement security. For pensions, this is catastrophic in ways that most pension beneficiaries have not yet fully understood. Defined benefit pension plans, the kind that government workers, union members, and many long-tenured employees rely on, depend on a specific set of assumptions: long-term real asset returns, stable contribution bases, growing workforces funding future obligations, and manageable liability growth. A structural break attacks every single one of those pillars simultaneously. Lower real growth means lower real asset returns. Declining labor force growth means fewer contributors relative to beneficiaries. Productivity stagnation means lower tax revenues to backstop public pension obligations. The math becomes almost impossible to close without either benefit cuts, contribution increases, or both. But that's not the real problem. What I call the big secret of the pension exposure is this. Most Canadians with defined contribution plans, RRSPs, group savings plans, self-directed retirement vehicles, are carrying a level of asset allocation risk they may not fully appreciate. For years, financial planning in Canada operated on the assumption that a diversified portfolio of Canadian and international equities, bonds, and real estate would generate sufficient real returns to fund a comfortable retirement. That assumption was built on a growth model, and the growth model has just been officially declared broken by the central bank. This is not a conspiracy. It is a stated policy from the Bank of Canada itself. The question for every Canadian investor is now devastatingly simple. If potential GDP growth in Canada is structurally lower going forward, what does that mean for equity returns? If productivity growth is lagging, what does that mean for corporate earnings expansion? If the labor force is barely growing, what does that mean for consumer spending, housing demand, and the income flows that support asset valuations? The data forces one conclusion. Asset allocation strategies built for the old Canada, the Canada of robust trade integration, rising productivity trends, and expanding labor markets, are now mismatched to the Canada the Bank of Canada just officially described. And the gap between the strategy and the reality is where portfolio risk lives. Here's what that looks like on the ground. A 58-year-old construction worker in Ontario, RRSP built over 30 years, home equity that represents the single largest component of net worth, pension through a union plan. This individual's entire financial future is built on three pillars: real estate appreciation, pension fund returns, and retirement savings growth. The structural break the BOC just confirmed puts pressure on all three simultaneously. Real estate demand softens as labor force growth slows and affordability constraints bite harder. Pension fund returns compress as low-growth environments reduce real asset returns. RRSP growth slows against a backdrop of structurally weaker equity performance in a lower productivity economy. This isn't happening to the market, it's happening to you. And we haven't even reached the breaking point yet. Because layered on top of the productivity failure and the trade rupture is a demographic reality that the Bank of Canada also acknowledged directly. Canada's population growth has been driven in recent years by immigration at historically high levels. Politicians and commentators have cited this as evidence of economic dynamism. And here is the counterintuitive pivot that changes everything about that narrative. Population growth and labor force growth are not the same thing. This is the detail even analysts tend to miss. You can have a growing population while simultaneously experiencing a stagnating labor force. This happens when the participation rate plateaus, when new entrants to the workforce are concentrated in lower productivity sectors, when the educational and skills matching between immigrants and available high-value jobs is inefficient, or when the structural sectors of the economy that require experienced workers are not generating the demand those workers would fill. Canada is running into all of these constraints simultaneously. This is where common sense actually becomes your enemy. Most people hear immigration is high and conclude labor force is strong. The Bank of Canada is now telling you that is wrong. The labor force will hardly grow at all. Those are the BOC's own words. And a labor force that barely grows cannot drive the kind of economic expansion that generates the real asset returns, the real wage growth, the real corporate profit expansion, the real tax revenue base. that retirement portfolios, pension funds, and mortgage-carrying households depend on. Here's what that looks like on the ground for a different kind of household. A dual income family in Vancouver, both earners in sectors exposed to U.S. trade disruption. Mortgage carrying costs that have risen sharply with interest rate increases. A combined RRSP balance that represents their primary retirement vehicle outside of home equity. They are carrying what a financial planner would call concentration risk without knowing it. Their home, their single largest asset, is in a real estate market that depends on continued population-driven demand and income growth. Their retirement savings are exposed to equity markets that depend on the same economic growth assumptions the BOC just walked back. And their employment income is in sectors facing structural headwinds from the trade realignment. The systemic risk here is not abstract. It is personal, it is financial, and it is accelerating. This is not a prediction, it's math. The Bank of Canada cannot fix this with interest rate cuts. That is the most important sentence in this entire story, because it means the institution that Canadians have relied on, implicitly, instinctively, to backstop economic stability has just told you that its primary tool is no longer sufficient for the problem at hand. Rate cuts can stimulate borrowing. They cannot increase labor force participation. They cannot rebuild supply chain architecture. They cannot raise productivity. They cannot reopen a trade relationship that has structurally fractured. And once you understand this mechanism, everything else makes sense. The Bank of Canada lowering rates into a structural break does not produce a recovery. It produces a prolonged low-growth environment. It produces compressed real returns. It produces a slow, grinding erosion of purchasing power that is invisible in the short term and devastating over a decade of retirement saving. It produces what economists call a low neutral rate trap, where rates are cut as far as they can go, growth remains structurally weak, and the central bank runs out of road. This is where the next fracture begins. We don't have months. This is already unfolding in the numbers, in the labor market data, in the trade flow disruption, in the productivity measurements that have been telling this story for years before the Bank of Canada finally put its name on it officially. And what comes next? The final layer of this structural collapse is the part that most directly touches your credit exposure, your mortgage risk, and the real-world timeline of when this becomes impossible to ignore. Let me cut through the noise on what happens next. When a central bank officially declares a structural break, it is not making a forecast. It is issuing a reclassification. It is telling the entire financial system, every pension fund manager, every portfolio risk officer, every mortgage underwriter, every bond market participant, that the assumptions embedded in their models are now officially outdated. And when assumptions change at that level, the repricing that follows is not a market event. It is a monetary event, and this part has already begun. Here is the mechanism that most financial commentators are completely missing. The Bank of Canada's admission is not just an economic statement, it is a credit statement, because the entire architecture of Canadian lending, mortgage rates, business credit, government bond yields, consumer debt pricing, is built on assumptions about future economic growth. Lenders extend credit based on the expectation that borrowers will have income tomorrow sufficient to repay obligations made today. That expectation is calibrated against economic growth projections. A structural break rewrites those projections permanently. Here's the part they never put in the official reports. When potential GDP growth falls structurally, when the economy is officially assessed as permanently lower growth, the neutral interest rate falls with it. The neutral rate is the rate at which monetary policy is neither stimulating nor restricting the economy. It is the baseline, and when the baseline falls, the entire yield curve recalibrates. Bond yields compress. Real returns on fixed income, the backbone of conservative retirement portfolios, the bedrock of pension fund asset allocation, fall with it. This is not theoretical. It is the direct mathematical consequence of what the Bank of Canada just announced. For the millions of Canadians who hold bond-heavy portfolios inside their RRSPs, pension plans, and defined contribution savings vehicles, this is a duration risk problem of the first order. Bonds purchased at yields that reflected old Canada growth assumptions will reprice as those assumptions are revised downward. And real returns, the returns that actually matter for your retirement purchasing power, will compress further in a low neutral rate environment. For pensions, this is catastrophic in a very specific way that is worth understanding precisely. Defined benefit pension obligations are calculated using a discount rate, typically tied to long-term government bond yields. When yields fall, the present value of future pension obligations rises. The pension becomes more expensive to fund at exactly the moment when lower real asset returns make funding it harder. This is the pension funding squeeze. It has been developing quietly in the background of Canadian financial markets for years. The structural break the BOC just announced is the mechanism that turns a background pressure into a foreground crisis. This is where the first domino falls, and it does not stop at pensions. The credit and debt stress embedded in Canadian household balance sheets is now exposed to a structural growth slowdown in a way that rate cuts alone cannot resolve. Here is the detail even analysts tend to miss. Canadian households carry some of the highest debt-to-income ratios in the developed world. The majority of that debt is in residential mortgages, floating rate, variable rate, and fixed rate mortgages coming up for renewal at terms set years ago when rate assumptions were completely different. The mortgage renewal wave facing Canadian homeowners over the next 18 to 24 months is not a routine refinancing cycle. It is a systemic stress event landing directly on top of a structural economic break. Here's what that looks like on the ground. A homeowner in Calgary who took a 5-year fixed mortgage in 2021 at historically low rates is approaching renewal in a rate environment that has already risen substantially. Their income growth, already constrained by the productivity stagnation the BOC has now officially confirmed, has not kept pace with the carrying cost increase they are about to absorb. Their home equity, which they had planned to leverage as part of their wealth preservation strategy, is now subject to valuation pressure as slower labor force growth and compressed consumer spending reduce the demand dynamics that drove Canadian real estate prices through the previous decade. This isn't happening to the market. It's happening to you. And the credit tightening that follows is not hypothetical. When mortgage carrying costs rise, discretionary spending compresses. When discretionary spending compresses, consumer-facing businesses feel the pressure first. Retail, hospitality, services. When those businesses feel pressure, employment in those sectors softens. When employment softens, consumer confidence falls further. And when consumer confidence falls in an environment where the central bank has officially declared that its primary tool, rate policy, cannot address the underlying structural problem, you have a feedback loop with no clean exit. This is where the cascade becomes unstoppable. Here's the part nobody expects. The conventional assumption about a Bank of Canada rate-cutting cycle is that it relieves mortgage stress and stimulates borrowing. And in a cyclical downturn, that is broadly correct. But in a structural break environment, in an environment where the BOC has explicitly said that potential GDP growth is permanently lower, that the labor force will barely grow, that the trade architecture is fundamentally altered, rate cuts do not produce the same stimulative effect. Because the constraint is not the cost of borrowing. The constraint is the absence of genuine growth generating opportunity on the other side of that borrowing. This is where common sense actually becomes your enemy. You hear rate cuts and you think housing recovers, borrowing increases, economy rebounds. That is the cyclical playbook. It does not apply here. The Bank of Canada is cutting rates into a structural break. They are reducing the cost of credit inside an economy whose productive capacity is contracting. The result is not a recovery. It is a prolonged period of low growth, low return, high uncertainty, precisely the environment most devastating to retirement savers who are depending on real compounding returns over a 10 to 20-year horizon. This is not a prediction. This is arithmetic. Now consider what this means for portfolio rebalancing in real time. High net worth investors and institutional money managers are already beginning to recalibrate their asset allocation in response to exactly this kind of structural break signal from a central bank. They are reducing duration risk in bond portfolios. They are reassessing Canadian equity exposure in sectors most dependent on U.S. trade integration. They are increasing allocations to hard assets, inflation-sensitive instruments, and internationally diversified positions that reduce concentration in a single low-growth domestic economy. They are, in the language of professional portfolio management, hedging against the structural risk premium that the Bank of Canada just officially placed on the Canadian economic outlook. The question is whether ordinary Canadians, the RRSP holders, the pension beneficiaries, the homeowners with mortgage-heavy balance sheets, are making those same adjustments before the window closes. And this is where the vanishing window becomes the most urgent part of this entire story. The window is not closing, it is slamming shut. Here is the timeline that matters. The structural break is officially declared. The labor force growth projections are revised to near zero. The trade architecture is confirmed as permanently altered. The productivity divergence between Canada and the U.S. is on record and widening. Institutional investors who move faster than retail investors are already repricing Canadian assets to reflect this new reality. Bond markets are recalibrating yield curve expectations. Real estate markets in trade-exposed regions are beginning to absorb the employment uncertainty. By the time this hits the mainstream financial headlines, by the time your bank sends you a letter about your mortgage renewal terms, by the time your pension fund publishes its next annual report with revised actuarial assumptions, the adjustment will already be underway. Certainty always arrives too late to act on. This is the detail even analysts tend to miss. The Bank of Canada did not bury this in a technical paper nobody reads. They titled the speech, Canada at a Crossroads. They used the phrase structural break, a term with precise, serious meaning in macroeconomics. They explicitly projected near zero labor force growth. They explicitly acknowledged that monetary policy cannot fix structural supply constraints. They are telling you, in the clearest language an institution of that kind can use, that the rules of the Canadian economic game have permanently changed. For the average household, this means one thing above all others. The wealth preservation strategies, the portfolio risk frameworks, the retirement income assumptions, the real estate equity calculations, all of them need to be examined through the lens of a permanently lower growth Canada, not recessed, not temporarily slow, structurally, permanently altered. And this is the crack that becomes an earthquake. Because what the structural break means over a 10-year retirement savings horizon is not a one-year compression of returns. It is a decade of compounding underperformance against assumptions that have not yet been updated. It is the slow erosion of purchasing power through persistently low real returns. It is the widening gap between what a retirement portfolio was projected to deliver and what a structurally broken economy can actually produce. This is not news. This is math that has already started running. Here's what that looks like on the ground for the final time. A 52-year-old teacher in Ontario, defined benefit pension, RRSP, as a supplement, modest real estate exposure, 15 years from intended retirement. This individual is in the exact demographic the structural break will hit hardest, too far from retirement to have already locked in returns, too close to retirement to have the time horizon needed to fully adjust. The pension faces funding pressure from falling yields and lower real asset returns. The RRSP faces a structurally lower return environment, and the 15 years between now and retirement will unfold against a backdrop of near zero labor force growth, compressed productivity, and a trade architecture that no longer generates the economic momentum that Canadian asset prices were pricing in. We haven't even reached the breaking point yet, but the clock is running. Here's the final truth the Bank of Canada embedded in that February 2026 speech, and they knew exactly what they were saying when they said it. The old Canada, the Canada built on deep U.S. trade integration, rising immigration-fueled labor force expansion, housing-driven wealth accumulation, and a central bank capable of cycling through downturns with rate policy, that Canada is gone. The structural break is not a warning that it might end. It is a confirmation that it already has. The two prices are beginning to emerge. The official story, the one that says rate cuts will stimulate recovery and the fundamentals are sound, and the real story, the one the Bank of Canada quietly placed on the record on February 5th, 2026, the story of permanent structural adjustment, the story of a crossroads already passed, and this is the crack that becomes an earthquake. The neutral rate is falling, real returns are compressing, pension funding gaps are widening, mortgage renewal stress is building, labor force growth is stalling, productivity divergence is accelerating, trade architecture is fractured, and the institution responsible for monetary stability has just officially told you that its primary tool cannot fix the underlying problem. When the music stops, and it is already slowing, the only question that matters is simple. Do you hold a retirement strategy built for the Canada that used to exist? Or do you hold a wealth preservation framework designed for the structural reality the Bank of Canada just officially confirmed? The window for understanding the difference is not closing next year. It is not closing next month. It is closing now.